Welcome back to the channel. I'm Doug the Retirement Guy. Today we're continuing our little series of the new powerhouse income funds. Today we're going to break down TSPY ETF. It's been 16 months old, coming from Tapp Alpha. This has been a talked about fund, and we want to show you the good, the bad, the ugly, how it works, and everything in between. And most importantly, we're going to give you a 16-month review of the fund, giving you how much if you did a drip, if you did 50% drip, if you did a zero drip. So we'll give you all the information today. What TSP actually does? Well, first off, Tapp Alpha SPY Growth Daily Income. I got to put a question, a little asterisk there, because this is probably the number one question I get from people through our YouTube channel, through our Patreon, and many different sources that we always get the question, is this a daily payer? Is this a weekly payer? How does it go? Well, this is an exchange traded fund that mostly invests in large cap equities. The fund is actively managed, aiming to provide a balanced approach between growth and income from large cap equities. The fund holds a large exposure to the S&P 500 index and writes daily out-of-the-money calls using zero DT options. So the daily zero DTE strategy uses daily covered call strategy on SPY. Now that's collecting money. It's collecting premiums on a daily basis. It's not paying it out as a distribution. It's building up kind of into a savings account to pay out distributions. What this allows them to do is change their strategy on a daily basis. What's the market doing? How can we adjust? Where do we adjust? It sells out of the money options that expire the same exact day, and it resets the position every single trading day. So remember, when it says daily income, it's because of their covered call and their strategy of generating that income. So income versus growth generates potential income through that time decay of those covered calls. It maintains exposure to the SPY's overnight movements. Now, here's the biggest thing. It caps the upside in exchange for income priority. So there is some growth. There is some income generation. It's the maximized timing of the decay, and it reduces the time risk frame, and it makes it very flexible of a fund. So this is what makes this fund different from many other call options out there, that they're designing, that they're watching what's happening day in, day out, setting up for overnight moves so they can continue to generate as much potential income as possible. So when we take a look at the underneath the hood, now here's the big thing I'm going to start with. And I hate ever starting with negatives, but I'm going to start with this. Look at the growth pattern. It did have that April 2nd drop off. It recovered. It recovered right back up to its par level, $25.73 at the time of this video. Okay, but because of the capping of the call options, we're not seeing it climbing much higher. So the whole growth for the over 1 year is only 1.36%. So when they say growth and income, this thing's more, in my eyes, focused heavily on income versus its growth, because I just don't see the growth with the way they structure their call options. I don't see it giving the growth factor that anyone really would truly expect. Now, has the fund failed? Definitely not. It's assets of $213 million. Expense ratio very well in range of 0.77%. So that means if you invest $10,000, you got $7.07 is actually going to management fees. You got 8.39 million shares outstanding. Its distribution yield over the past 12 months shows a 13.61%, paying out $3.50, and it pays out monthly. Now, this fund came out August 14th of 2024, And when we look at the low and the high, you're basically at a $20 to $26 range. So it's a magical little number that its balance is right between. When we look at the performance, now the performance is your total returns. Since inception, 18.32%. 1 year, 16.96. Year to date, which is what, 28 days into this, is 2.14%, and the first month is 0.88%. So the numbers are still all positive. Things are looking good because of the big income. Monthly distributions average about 30 cents per month. The trailing 12 months yield was 13.57%. Return of capital reduces the cost basis, so it's used as a tax purpose and as a continuously to keep your distributions active. And it creates a deferred tax liability. So when you take a look at comparison, and the big comparison is TSPY versus SPYI, giving you basically a 12-month review of both funds, identical snapshots across the board. What do we look at? Well, total returns, 17.56 to 15.35. We take a look at the share appreciation, 3.5% versus 1.55. So again, win-win is TSPY. They have the total return, plus they have an increase in the share price over SPYI. Income actually 14.06 versus 13.83. Well, I don't know, but the 0.17% is not that big of a difference to give a winner one way or the other. And monthly distributions, a penny difference between the two. So realistically, it's your total return. It's that appreciation that they give you, a little extra appreciation that pumps it up to that 17.5. So the needle kind of leans a little bit to TSPY versus SPYI. But it's not big enough for me to declare a winner, nor will I declare a winner between these two funds. I personally own both of them, and I like that I have both in my portfolio. Now, the tax implications that nobody ever mentions about. This is a big thing. You know, SPYI has its 60/40 contracts. It's doing the long-term setup so you're not paying as much taxes as the capital gains. Well, the surprise tax facts, most distributions are taxed as short-term capital gains, subject to ordinary income rates. Now, the highly effective tax portfolios, Roth accounts grows tax-free. The capital gains is not triggered upon a sale. Best place to put these. Taxable accounts, distribution tax at ordinary rate income rates, and high tax burden on the ROC distributions. I really put it, this is the factor between TSPY and SPYI, is the whole tax package across the board. Though victory would go to SPYI because of the tax side of it, but you have to know this getting into it, that Tapp Alpha does not use the tax purposes as much as using the ROC that they do use. So that's the critical piece between the two. Now, we did something here that's going to be really unique for you. We gave you 3 strategies investments. We kind of took and said, look, if we have $100,000 invested in each one of these in this fund, what would happen? So with TSPY, what we're really trying to find out, and the first one is, if we did 100% drip in the fund, what would it look like? Well, our total return would be at 24.88%. Now, we did this over the past 16 months, so don't get crazy that you're looking at this and saying 24%. You just said it was only 18% or 16%. This is since its birth for 16 straight months. It gave out a 24.88% total return. The yield return is 20.88% with a 4% growth of the fund. And because you dripped all of that, which is basically you took your investments, your distributions, you reinvested them back into it, you really have zero income for you to do with because you've put it all back into the new stocks. This is great if you're building up to maybe a retirement fund or you're trying to get the growth out of a fund that you're using big returns, big yields to get the thing moving forward. Then we said, what if I did just 50%? Now, a lot of people ask me is, how do you do 50%? Well, you're taking your distributions and then you're making the decision how much you're going to put into it. 50% of your distributions is how I take it and put it. Your total return doesn't change that dramatically much, 23.96. A 19.96 total or yield return. So you can see the difference what 100% and 50% really does. The fund's going to continue to grow at the same amount because you're not touching that. But what you're gaining is $623 of monthly income. And then so basically this one here is if you're just starting into retirement, you want some income, you're not ready to take the full amount and work accordingly. Or if you are into retirement, this is probably the fund that you'll use, which is what I really use, a zero drip. So we're taking no distributions and reinvesting them. You're taking all the money out and saying, I'm going to spend this on what I want to spend it on. Live as you want to live. So your total return is actually 23.09. So you can see about a 1% difference between a 50% drip and basically 1.8 off of a 100% drip. So there's not a big difference between the two. But your yield is where you see it, 19.06. But you're collecting $1,305 of income per month on average. I believe it actually, got it right around 1370, somewhere right in there, but it's very, very consistent. So you look at the 100%, 50%, 0%. You can see in the bar chart on the right-hand side the difference in those total returns over 16 months of doing this. So if you have $100,000, basically you're going to end up about 124,000 in the 100% drip. If you're doing 50%, you're going to probably have, again, about 119, I believe, right around there. So you can see really that dripping does not really make this one big change across the board. But use it to what fits your portfolio and fits your life the proper way. The hidden risks. No downside protection. The covered call strategies offers no meaningful downside buffers. During the 2025 correction, it was down 15% decline. The losses mirror the S&P 500 during the market corrections. The cap side, the daily call writing limits the participation in the market gains. So you're not going to see this one drive quickly. If the market takes a huge burst, you're not going to see this in the program because of those daily writing options limit that cap side. The execution risk. Zero DTE options have a wider bid, asking spreads, and lower liquidity. And the concentration risk. It's non-diversified structure with heavy SPYI exposure. 99.49% is allocated to SPY. Now, SPY is diversified, but you're banking all on SPY to go up, down, sideways, whatever you want it to do. Okay, there's only 6 holdings total in TSPY, and that's because it's SPYI, and then it's all its different covered calls. So who should actually own TSPY? Well, income investors like retirees. We prioritize that constant cash flow potential. You need stable monthly income? They offer it. Tax advantage accounts, the Roths, the traditional IRAs are definitely strong for this type of fund. Now, we always say a small portfolio allocation, 5 to 10% of your total portfolio should be in TSPY. That provides more stable income. This is not a fund that I would turn around and say, put all your money in, put everything you got in the TSPY, but you build a smart portfolio by using a smaller allocation into just this fund. This is not suitable for people looking for growth. Okay, if you're looking to grow your portfolio, it's not really a growth program. Now, you can do it through the drip, you can change it accordingly, but it's not designed for that. It's a high opportunity cost of capped upside is what does it. Young savers, I would not recommend this one. It's a 1 to 2% annual underperformance of SPYI. I'd rather see you put the money in SPYI directly. And taxable accounts. If you're high tax burden on the ROC or classified with short-term capital gains, these are not funds you want to mess around with in taxable accounts. Simply open up a Roth, open up a traditional IRA, put it over to there. The bottom line assessment, TSPY delivers on its promise of that income through a sophisticated zero DTE covered call strategy, but investors must understand the true costs and the true trade-offs. The strengths, it's impressive 22.65% return over 16 months, basically banking it on if you're doing drip, not drip, but that constant distribution at 30 cents. It's a strong execution of those zero DTE strategy during moderate volatility. Costs and limitations, 50 to 60% of the fund is classified as ROC. And that does mislead the yields partially. The upside capping, that's going to control your growth, and no downside protection, mirroring basically SPY's declines. So these things kind of mix together. So the bottom line, is it a good strong count? Yes, I think it is a powerhouse. It has a particular reason to be in a portfolio. That's my personal opinion. That is nothing on I'm just a regular retail investor, but that's my take on it. It's a solid piece for retirees. Tell me what you think. Leave a comment down below. I'd love to hear what your thoughts are on TSPY.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments below and join our Patreon to support the channel. I'm Doug, the Retirement Guy.